Good evening, everyone, and thanks for joining us. Welcome to BOQ Specialist's second webinar in the Know series. I'm joined tonight by our great partners, Ecovis Clark Jacobs and Heath Stewart, and I'll intro Heath Stewart in a minute. Firstly, my name's Tim Bowering, and I'm the Regional Manager for BOQ Specialist New South Wales and also the National Head of Partnerships. Heath, thanks for joining us. So Heath Stewart is a director of Ecovis Clark Jacobs, an accounting firm with over 20 years experience advising clients in the medical, dental and veterinary industries. With clients ranging from undergrads through to household name corporates, Ecovis Clark Jacobs consults on a variety of business matters for healthcare professionals, including setup and buy-sell transactions, benchmarking and practice consulting. Heath works together with his clients, tailoring advice to each client's specific needs, such as assistance with industry KPI comparison, forecasting, projections, financing, and efficient tax structuring. As well as this, Heath supervises the firm's audit and assurance engagements, including litigation, support, and valuation. He's also a regular presenter at seminars for practitioners in Australia and New Zealand, although maybe not so much New Zealand at the moment. Heath also regularly contributes articles on taxation and practice management. There's a long-term contributor to the ADA magazine news bulletin. Thanks for joining us, Heath. Great to have you back on the BOQS webinar series.
I was just going to say thank you very much for the warm introduction. Pleasure to be here again.
Great to have you. So what we're going to go through tonight, the timing is sort of perfect. One of the first webinars we did back in April was around the banking relief package and hardship assistance. We are getting to the end of the 6-month banking relief package that was rolled out through the Banking Association. So there's a little bit of what's next in regards to that. There's also some changes to government stimulus, which Heath's going to kick off and run through, as well as the government's 250k SME loan. We'll talk about the changes to that. And I think finally Heath will cover off on the instant asset write-off and its extension through to the 31st of December this year. So a bit of content to get through. We'll probably talk for about 20-25 minutes through the content, and then we'll have time for questions at the end. As always, if you have a look on the right-hand side of your screen, you can click the chat button, and under the chat, you'll be able to lodge any questions you'd like us to answer at the end. When we get to the end, Heath and I will both be here to answer any questions you have. And if we do run out of time, we'll try and have you off the line before 7 o'clock. We can come back to you afterwards. All right, Heath, so on that note, I'll flick over to you if you'd like to kick off with JobKeeper.
Yeah, thanks very much, Tim. And just to reiterate that, just so on the right-hand side of the screen, of people's screens, there would be a little chat button. If they click that, they'll see the chat that's happening. And also, people, don't ask anything that's private or direct in nature in relation to your own practice or your own staff. Keep it pretty general. Bear in mind this is an open forum. And also, we'd encourage everyone to ask as many questions as possible, because if you're thinking it, I'm sure someone else is. And the only silly questions are the ones you don't ask. So just as a bit of a recap now on JobKeeper for everyone. And look, I think most people should be pretty well across the first tranche of JobKeeper. And we were proven slightly wrong in the sense that we thought that because there was monthly reporting with the original JobKeeper program, that the tax office would start to say, well, look, hey, your turnover is back to what it was last year. Maybe we'll pull the pin before 30 September, or 28th September. But in terms of that, it seems that the government has decided to just continue in. Once you're in, you're in. And so as a result of that, it's meant that pretty well anyone who had an original eligibility, I know particularly for those of you in the dental space where you had a mandated shutdown, it meant that effectively once you're into the program, you are in till the end of September. Now, I won't go into the minutiae of the application of the JobKeeper program, and that's been covered I think over and over again. If anyone has any specific questions on the application of the past, then please ask. I think that the good thing that's happening going forward in terms of this, and this is going to be for those businesses that will have an eligibility in terms of this post 28th of September. And that is, I guess, two things. Firstly is that the program was not planned to run past the 28th of September. So what the ABS data is in, the government has recognised that some industries are still in real trouble. And of course, those industries are broadly around hospitality, tourism, restaurants, catering, things like that. Specifically, a lot of healthcare professionals have been affected, particularly those that were heavily reliant on surgical lists. For example, the hospitals have broadly kept the lists empty, keeping the beds available for COVID patients as required. That has been a big concern. But effectively, what we're going to have to look at going forward for continued eligibility, and this is the key thing to understand, is that you have to have demonstrated a decline in turnover in the quarter up to 28th of September 2020 of 30% or more than you had last year. So in simple terms, if I had a turnover of $90,000 for the September quarter last year, then what I would need to see is a decline in revenue greater than $27,000 for the period up to the 28th of September. Now, if that's the case, then what that means is that JobKeeper will now facilitate me continuing to get payments on staff past the 28th of September. One of the other things as well is that there is a possibility, we've missed the August deadline, but if you have staff that were not eligible for JobKeeper as at the 12th of March, effectively when the legislation, so this cash flow boost was 12th of March, existing employees were 1st of March. So in terms of that, sometimes if you had casuals that had not been with you for a full year, at that point in time, they weren't eligible for JobKeeper. In terms of that, if they're still employed and were employed on the 1st of July, then what we're seeing is that there may be a lot more of your employees that are now eligible that were not previously. So in terms of that, unfortunately, the registration for payments in August has closed, but it means that you may have an eligibility for staff in the month of September. Okay, so that's very important too, because if we're going to be looking at payments to employees going forward, because your decline in turnover is for this quarter is 30% or more than last year, then having as much access as possible to JobKeeper payments for staff will be a real boon. So that's sort of really the key thing we need to understand. And then, of course, the other takeout there, of course, is the payment has been reduced from $1,500 a fortnight to $1,200 a fortnight. And look, I won't go into the application on if it includes super or leave or those sorts of things like that. I'll let that be. One other thing that we need to also understand, and this is probably more an industrial relations comment, so I'll be pretty light on this, and that is that if you have a decline in turnover that's greater than, it's basically, you don't have to have 30%, but it needs to be 10% or more, then it enables you to access the industrial relations concessions that are afforded businesses as part of this economic stimulus package. And that's the ability to reduce hours of staff, not reduce permanent contracts or permanent rates of pay, but to be able to reduce hours for a period of time and get certain exemptions from the industrial relations rules that there were previously. Again, I would counsel you to seek specific IR advice from your various professional body who has an employment advisory section in there. Now, in terms of this, just running through some of the headline things that I'd run through there previously, and this is that if I've employed a new employee that is a full-time employee by the 1st of July, so I've employed someone in June, they're a full-time employee, then it would mean that this person may now be eligible for JobKeeper for July, August and September. Now, if you haven't attended to your registrations, that means that effectively you would only be able to get that for the month of September. But it also means that if you have casual staff that were not eligible at the point in time that JobKeeper was introduced, then these staff, if they have triggered their 12-month employment by the 1st of July, then they will be eligible for the JobKeeper payments as well. In terms of that, the eligibility criteria continues on as it was originally, and the key eligibility criteria going forward will be a demonstrated reduction in turnover this year from last year of 30% or greater, which will need to be reported in a business activity statement. Now, I think also important for people to note in relation to this, Tim, that there was all sorts of complicated rules and discussions around what is turnover. Is it on what I invoice my patients? Is it what I collect? Does it include gross receipts invoiced if I was an orthodontist? Does it include the entire treatment plan? How do I look at these things? What I would make the first observation around is that the submission of a BAS is a legal instrument of a statutory declaration. So make sure it's correct, right? And so, and I think in terms of this is that if you, what we'll broadly see is so our numbers across our practices are showing that most practices are broadly back to normal, give or take 10% or so. There's some practices, particularly those that were heavily reliant on surgical procedure, for example, or are metropolitan based and have had to close, are clearly at 30% turnover down. So there's some of that they're 100% turnover down. So completely eligible for JobKeeper going forward. And then there's this sort of stuff in the middle. And the stuff in the middle, again, I would counsel people to again get some specialist advice on it, because if you get it wrong, we're already starting to see the ATO starting to conduct some audit activity, and we suspect they will crack the whip very hard and make some examples of businesses. The whole sort of old-fashioned concept of shoot one, educate thousands is pretty well the way the ATO, we suspect, will operate. And I hope there's no one from the ATO listening. I'm sure they're not going to shoot anyone, but they will. What they will do is make an example.
Yeah.
And they'll be looking for someone they'll be trying to find someone who's been very naughty. But the key thing to understand is that if you haven't applied JobKeeper correctly, we're not an administrative or fine territory. They did change the law to make it actually criminal. And that was, I think, to make sure that everyone played by the rules. And broadly speaking, I think everyone has. So certainly that's what we're seeing. But the JobKeeper 2.0, I think we need to be very careful about. In terms of this, the new reference of eligibility, I think I've made clear is for the period 1 July through 28th September. I think that's quite clear. In terms of this, we need to reassess our actual turnover for the quarter to 28th September. Then we'll also need to reassess our turnover for subsequent quarters if we're going to continue to operate like this. Also, bear in mind the JobKeeper payments do not constitute income for the purposes of filing your business activity statement. They will be income for taxation purposes, but it won't be for the actual overall reporting. Now, in terms of this, I put a link up here as well, because I think that there's a couple of things the government has done very well through this process. And look, I realise it can be very frustrating at times where the government has not legislated. So we've got a media release. This is what we're doing. The legislation hasn't been enacted yet, and so people are saying, "Well, I'm trying to make financial decisions in my business about something that is not the law yet, and we only have an information gazette." The advantage of the fact that the government has delayed this slightly is that when they are releasing the legislation and the information gazettes, they're pretty good. They're on point. They're well considered. The legislation thus far has been very well drafted, and this link here to the Treasury JobKeeper fact sheet here is it's a great document. It's pretty punchy. It answers most of the questions. I guess I would say, as I've said previously, this will capture most of the needy, but there will always be people that miss out, and unfortunately, that's just the way these things go. And often that's not the way things go with very well planned legislation that we've got years to plan. There can't always be a winner. I think we're trying to capture as many needy businesses as possible. I think, Tim, any questions? I think that's probably on to you now.
It was probably just one from me. Was there something about a ratchet down of JobKeeper from the 1,200 over time as we move off? And has the government set a drop dead date for when effectively the plan's going to end?
Yeah, look, the drop dead date from when the plan is going to end in terms of this is broadly going to be first quarter next year. Yeah. So in terms of that, as we're seeing the drop from 1,500 to 1,200 down, then there is increasingly onerous conditions in terms of the eligibility of the JobKeeper program subsequent to that. That's what the dialogue that we're having, I guess, broadly with our clients and other different business partners is that the concern around the Australian economy, I think, is more around what will happen when it stops completely, and that for most businesses will really happen after September, and businesses within certain sectors and industry segments, again, like restaurants and tourism and hospitality and things like that, that won't be having eligibility for it after the first quarter in the 2021 calendar year.
Right.
So in terms of that, I think that's the great concern. But again, everything is so fluid at the moment.
Yeah.
And just I can just make one other topical observation. There are concerns around hospitality and tourism and certain things like that. I don't know how many of the people attending this webinar tonight have tried to book accommodation in the state that they reside in and had a look and seen how hard it is to get a reservation in a hotel. And again, that's what I'm saying. I'm not sure that the noise coming from certain sectors equates to the reality. Because for example, I was talking to a colleague in another firm that were trying to book a staff retreat, get away for a dozen or so different people, and they could not get a booking anywhere in New South Wales until March next year.
Yeah.
So that indicates to me that, and there's two things. Firstly, it's limited numbers in some of these venues, but secondly, it means that Australians are travelling domestically, which is a very good thing for the economy.
Yeah, absolutely.
Yeah.
I'm not booking hotels, but I've certainly tried to book some national parks, which you have to book properly now, and it's the same thing. You can't get a campsite for love nor money at the moment.
Yeah.
Thanks, Heath, for covering off on that. That probably leads in well to the banking relief package. So just to start, I might give a quick update in regards to what it was, but also the take-up of it as well, and what it's going to become. So back in March, all banks sort of pivoted very quickly to offering the banking relief package, and that was to provide up to 6 months worth of payment deferrals for your business if you've been affected by the pandemic. We had a really large take-up straight away. Within, I suppose, those 4 weeks from the 20th of March through to the middle of April, that's pretty much all we did was process those requests. And what we found, though, is as we came through April, obviously the dental industry was shut down to a degree, but as everything started to open up in early May, a lot of customers actually wound back the banking relief package and either started making payments from that point in time and didn't take the 6 months relief, or actually, repaid all of the outstandings and just moved on, which was good. It showed a good bounce back. There are definitely customers, though, who are still under banking package relief, and that does come to an end or starts to come to an end from September. So before I go into how that's going to be extended, I just wanted to cover off and say, for any businesses out there which are struggling at the moment and you didn't take advantage of the 6 month deferral, and that might have been because you didn't need to at the time because business was still trading really strongly, or you used your cash reserves to sort of trade through that period, but you've now used that up and you need some relief, you can still apply for the 6 month payment deferrals up until the 30th of September. So that gives you, about 4 weeks to still apply for it. So reach out to your financier and ask the question. And it's automatic eligibility for any client with less than $10 million in business debt, no payment arrears for the last 90 days, has less than 20% foreign ownership, and for any commercial property owners, just basically giving a commitment that you're not going to terminate leases or evict tenants during that period. So that is still there and still open for the next 4 weeks. But obviously we will have customers coming to the end of their 6 month relief, and wondering what's going to happen next. So if I just flick into this, so the ABA has announced a 4 month term extension to the banking relief package, and this will be available to both customers with less than $3 million in business lending and customers up to $10 million in business lending. The criteria has changed slightly in terms of you'll be asked to complete a questionnaire, and if you answer the questionnaire and the responses come back in a certain way, which is really about, yes, my business is trading, it is still struggling, but post this 4 months, it should be fine, then effectively you're going to be automatically approved for that 4 month extension. If some of the questions are, there's concerns maybe about longer term challenges, then we do have a BRP team who will work with you to either put on the 4-month term extension or have a look at different options for restructuring things to try and make it easier. That questionnaire is not, it's in draft form at the moment, it's not complete yet. We're hoping to have that this week, and it'll be available. But customers who are coming off the banking relief package in August, September, are going to start getting a text message saying, hey, you're coming up to the end. If you're okay, payments are just going to go back to normal. You don't need to do anything. But if you still do need support, then please contact your banker and they can walk through the process with you. So I think it's a good initiative from the government or from the ABA to go and provide the extension. You know, in particular, our friends in Victoria are doing it really tough, and we really feel for them. So there's a lot of practices down there which have, you know, effectively been in quite a bit of lockdown for, you know, 5 months and maybe even a bit longer, and it's still into the future a little bit longer as well. So absolutely reach out if you're feeling you need an extension to that relief package. If I kick into the government, I know I struggled with this introducing it at the start, and I think that's because they've changed the name on it. So the government actually refers to it as the Coronavirus SME Guarantee Scheme. So this was released, I think it must have been in about May, and they said for any financier who had access to this, you could provide a facility up to $250,000, and the government would provide a guarantee for 50% of that loan amount. And this was to be used to fund the working capital in your practice and help it trade through. In the healthcare industry, we're really surprised with limited take-up in terms of the number of customers using these facilities. And I think there's a number of reasons. I think one, Heath, you talked about JobKeeper and obviously Cash Booster. They really help to prop up practices. If people were putting their payments on deferrals for 6 months and then potentially seeking some rent relief as well, they might not have needed this facility. And it was just a nice to have, but, you know, it was, you had to provide information to get it, and therefore you just leave it and don't worry about it.
Tim, it might also be worthwhile noting, and I noticed it, and I'm not saying the media is wrong, but what I would say is that a lot of the statistical information that we've gleaned from our client base in the run-up to 30 June is that for many businesses, whether as a result of JobKeeper and or cash flow boost, 2020 was actually a better year than 2019.
Yeah.
And that is not, and that's not 1 or 2% of our practice. That's a material percentage.
Yeah, I've seen that in a number of financial statements I've looked at on transactions, at how well businesses did trade through. So I think you're right. I think that absolutely contributed to it. So the government's, I think what they've gone is they've said, right, the take-up probably across industry wasn't massive, and we've still got a problem that we need to stimulate this economy. We need people to invest. So they have announced changes to the scheme, whereby the 250K will increase to $1 million. The government will still underpin 50% of that and for a longer period of time. But the key change is this facility can be used for investment in your business. So that means, you know, investment in commercial property, if you're looking for commercial property to put your practice in or relocate your practice into, or it could be for acquisition of practice as well. And that's something we're absolutely seeing at the moment is, you know, consolidation of different practices. It can be used for equipment, it can be used for fit outs, anything to do with sort of investing in your practice, this facility can be used for. So that's a huge change from what was proposed previously, and we are seeing a number of our customers look to invest at this point in time. You know, arguably commercial property prices are coming off a little bit because yields are going up, which is, you know, more attractive for investors, but it does also mean there's some, you know, attractive because of higher rents, but also it means the purchase prices are coming off a little bit as well. So there's opportunity in the market for customers to get in, but also you might have a large fit out or large equipment needs that you need to revamp your practice, and the government will effectively guarantee that for the next 5 years. This hasn't been finalised by Treasury yet, although they have put on their website that it's go live from 1 October. So they've got a bit of work to do. And then we will have a bit of work to do as well, because we obviously need to finalise our settings and stuff in behind that, and how we roll that out to customers. So it's more a watch this space. I know a number of customers are asking bankers about it at the moment, but it is set to go live in sort of the next 4 weeks. One thing, I don't have too much in terms of information requirements for what you would need for that facility. I assume it's similar to the previous ones, which will be, FY19 financials, 2020 management accounts, and clear tax portals. But the key one, which I'm sure will be there, which Heath will tell you, sorry, I've gone through all this, Heath will tell you is of key importance is having a cash flow projection for your business. Cash is king, is what repays your debts, and having a really robust cash flow as to how you're going to trade through this period is really key. So Heath, before I finish off on that, you might come to you for comment on the importance of cash flow.
Yeah, look, absolutely. I think in terms of the so I would say this at a large business level, it would be reckless on the part of any board to sign off on a new debt strategy or a new capital implementation strategy without understanding the cash flow ramifications of that financial decision. A board would be deemed reckless in terms of that and not doing their job properly.
Yeah.
In terms of your own practice, if you're looking at firstly investment, secondly borrowing money, thirdly deploying that money into capital or equipment or things like that in relation to the practice, then having an understanding of how the loan repayments dovetail into a projected new revenue stream, if it's a new service offering or the like, or how they plug into alternate debt that you're servicing versus replacing other debt, how that plugs into an investment in terms of, it could be a marketing strategy or things like that. Well, what are the assumptions that you are making about that? And plugging that in terms of just the business results of that project are important. And then, of course, at the bottom of these sorts of cash flows, then we've got, so we basically start, and what accountants often do, and bankers do this too, is they do something called a three-way forward forecast, where not only do they look at profit, but they also look at cash flow, and then they also look at balance sheet. And in terms of that, so what they look at is the interplay between your trading results, how that manifests in terms of cash collected. Then we overlay loan repayments, taxation, lifestyle, things like that on it, which presents a result on a month-by-month basis and also affects the family balance sheet. And you need to understand, if effectively if you're borrowing, that's the way that the lender is likely assessing you in terms of that. And it is a good thing to be across yourself. It's a very good thing to understand what the family outgoings and commitments are. Again, if you're making decisions that are material capital decisions without an understanding of your cash flow and or your likely balance sheet, then you're making that decision with a blindfold on. It's again, I would say the word potentially a bit reckless.
Yeah, absolutely. So the template that I've got here, which absolutely we can send to anyone who'd like it, is one that we created for the pandemic and for the coronavirus SME loan. What it allows you to do is to plot in your revenue for FY19 effectively month by month, and then apply a percentage reduction to revenue, or you could do a percentage increase if that's what your business is experiencing as well. You then do that as you go down through expenses the whole way through, and it'll calculate out your forecast for you for FY21. So easier than, probably having to start something from scratch. If you've already got last year's data there and you can just apply a rough percentage, it should give you a little idea. So if you'd like a copy of that, drop a comment in the chat section and we'll make sure that comes out to you. All right. So Heath, I might hand over to you to talk through the instant asset write-off scheme, and then as you finish up, I might just share, I suppose, some of what we saw with it as we ran up to the end of June.
Yep. Okay. So in terms of this, I think that, and again, following on from our discussion just then in relation to cash flow and the like, what we saw. And I'll take people back on a little bit of a history lesson, particularly for some of the younger ones. So what we saw in the GFC in 2008 and 2009 is we saw, prior to that day, the obligations of the taxpayer and the rules in relation to plant and equipment were quite strict. So generally speaking, what we would see is that, if, for example, a fit out on a medical centre or a dental practice or the like was usually depreciated over anywhere between 7 to 10 years. What we would also see too is that if you went and acquired some plant and equipment, desks, technology, things like that, then these sorts of things also had to be depreciated over several years. Computers were usually on diminishing value almost 4. Now, what sort of happened through the GFC is we had a real change. So once upon a time, we would write off things that were $1,000 or less. And then what we had is we had this enormous jump in terms of what we could write off from that $1,000 amount to $10,000 to $20,000. And so as a result of that, people were able to do very large, chunky renovation. And of course, these were always not an aggregate, but on a standalone. So it's not as though I spent $100,000 on a renovation, so that was over. Well, it was a $100,000 renovation. There was a whole lot of items for $5,000, several items for $10,000, and there might have been one big item for $25,000, a new slab or something. But everything else I was able to generate an immediate deduction on. Now, the good thing, and what was very much proved through the GFC, is that this encouraged the right kind of behaviour with business owners in Australia. So it encouraged business owners to spend money on capital works. So firstly, we're spending money, which generates GDP in the economy, encourages other Australian businesses to continue to operate, to employ more staff. It just, money rolling around in the economy being spent is great. And broadly, it's funded via the tax system. So in terms of that, if I'm buying this capital asset that has utility in my practice and generates revenue, but I'm getting a tax deduction for it, then what I'm spending $100,000 on might actually only cost me $50,000 after tax. Now, of course, it's much better for the government to help fund the economy that way than it is to simply just let you not pay them $50,000.
Yeah.
Because so if I'm simply running up a tax debt or a GST debt with the government of $50,000, that's not actually getting the right result. What I really want is I want to deploy $100,000 into the economy to keep everything kicking along and turning along. And so through the GFC, this was very successful. And what we've seen through these corona times is that the federal government has attempted to do the same thing. And again, they have done. This is a good job. The government is doing a good job of it. But in terms of just as a refresh on this, because it's important, because cash flow is important. So, and also I'd encourage everyone to investigate what facilities are available. Because Tim, I'm not a banker, but I know that there was some really interesting and innovative products offered by BOQ. You were looking at, effectively buy the asset, install the asset, and commence payments in a year's time, things like that. Now, of course, you need to be mindful of the cash flow obligation of that, but it enabled you to generate cash flow and revenue from new equipment prior to actually having to service the loan for it. And as well as that, what it did is it enables you to claim a tax deduction for something that you've acquired, installed, but may not have started paying for yet. So again, it was that style of product combined with what the federal government were offering, which is the kind of stimulus, the good type of stimulus that we want in the economy. So what happens is that we saw a really remarkable increase in this threshold up to $150,000, which is huge in terms of that, because what we need to understand is that it encompasses, now, cars are still limited to the luxury car threshold. I can't go and spend $150,000 on a Maserati and say, get immediate write-off. But if I was a farmer and spent $150,000 on a combine harvester or a truck, then I could get an immediate write-off on that. And there are assets that traditionally would be written off over somewhere between 3 to 5 years. Now, so what that means is that my threshold's gone up from 30,000 to 150,000. It's for businesses with an aggregated turnover less than $500 million. So I think that'll probably qualify for most of us here tonight. And installed ready for use, and this is critical too. Installed ready for use means not acquired and not sitting in a storage room. It means installed, plugged in, ready to go. And that's, of course, very easy with a vehicle, but might be a bit more different if I'm looking at installing an OPG or an MRI or something like MRI would be a lot more than $150,000. But if I was looking at doing, for example, a fit out, then that fit out sort of has to be done, not ordered, sort of done, sort of, turnkey, ready to go. So, but this is important because it affects your cash flow. Now, I'm just going to share a screen now, and I just hope this comes up. Now, I hope this has come up for everyone. Okay, great. So what I'm going to do is just run through just a simple tax example on this, and this is not, please, this is not a recommendation to act and go and buy a whole bit of kit or equipment, but it's more just to show you the really tangible effects of these things. Now, 30 June is gone. It's too late to buy something at 30 June, but the legislation runs through till Christmas, so the same rules apply. So as a hypothetical, if I had a doctor here, we've got a specialist doctor that's doing a mix of work in a hospital combined with private practice, and we're making, assume that we've made the decision to do a maximum super contribution, then it would mean that on the basis of this person earning $589,000, they would have a total tax bill of $250,000. So very good taxpayer, a good contributor to our country. Now, in terms of that, we would say that they've been earning this sort of income for quite some time, and they've been paying tax instalments of about $60,000 a quarter. Now, in terms of this, then, what we can see then is that tax is about right. Now, if I look at a tax timeline, what we can also see in terms of this here is that we can see that this doctor here, we would anticipate to be still making big payments every quarter in terms of their tax. Right? What we're also seeing here is we're probably also seeing we might be paying off our tax from a prior year. We've got cash flow boost coming in, okay, and then we've got PAYG coming in to pay for the staff. So we can see here we've got the government benefits mapped into this cash flow payment as well. And this is the sort of thing we would recommend that you have in a cash flow, because a cash flow is not just the profit that the practice makes. It's when is the best payment due? When is our tax payments due? Is there government stimulus that we need to apply? All of these things, and typically these sorts of cash flows would then also run down to loan servicing, car lease repayments, things like that. Now, as a hypothetical, if this high-earning doctor we can see was to avail themselves of a new item of plant and equipment, right, relevant to the tax period, then what we can see is that based on this, with the tax instalments that we'd already paid, we would generate a refund of $71,000. So almost half of what the investment made was. Now, this is, of course, assuming that the doctor is at the highest marginal tax rate. So I wouldn't encourage someone to spend $150,000 if we only earned $150,000.
Yeah.
The reason being is of course, you get maximum utility out of the tax deduction at the highest marginal rate of tax. So in terms of if I was someone that only earned, for example, $150,000, then that decision might be made to spend $30,000 or $40,000, or maybe only $5,000 or $10,000. But the reason that this is relevant for tax planning purposes is that if this is the case, and I've made that decision, and let's say this decision is made this financial year, well, what I would do is, well, hang on, I wouldn't be paying this instalment here. Right? I wouldn't be paying these instalments here. I would be reducing these instalments down. Right? I'd be reducing these down materially, because what I would understand is that I wouldn't be paying instalments of this rate. I could legally reduce them down to a reduced rate. What this would do in terms of my tax timeline here, in terms of these, that would reduce these down as well. Now, if I was making an investment decision on buying this item of plant and equipment or fit out, then I absolutely must understand how this affects my taxes. Because if we're talking about this affecting your taxes and the tax differential between making your standard instalments or making reduced instalments because you understand on the money that you've spent, then I would be much better to have that $60,000 to $70,000 saving sitting against my home loan, which might be non-deductible, or being available to invest into the practice on more staff or marketing or advertising, or just sitting in a bank account, because we know that in terms of this, that taxes will go up at a later time. But in terms of this, what I guess we're trying to demonstrate here is that if you make those decisions to to invest in new capital or equipment items for the practice, then in terms of that, there can be a really tangible tax effect on these, but it will be absolutely wasted unless you take advantage of it and quantify it, and then apply those savings and then redeploy them back into your practice. So that's just it's a straightforward example. You can run these so many different ways for different peoples with different practices, of course. But in terms of this scenario that I've run through here, I'll stop sharing. That I've run through here, it was simply just to demonstrate effectively how these things can work.
Yeah, and that last time for me, when I saw that prior to June, that was the light bulb moment for me. You know, lodging your FY21 tax return at this point in time, that's a long way off, right? So yeah. How can you you can bring the deduction effectively forward and offset it against your installments, you know, so long as you meet the right structure and things like that.
You can legally vary all of those things. There are ramifications if you vary them too much. But if you're looking at these investments and you know what they are and you can track it, you can quantify it, then again, these things are easy to do and quantify and calculate. So yes. in terms of that, then on this slide here, we've simply just got some of the rules. Now, some of these rules are relevant under the asset section too, because not only can we write off new stuff, but we can write off secondhand stuff. So again, the farmer could buy a secondhand truck. As well as that, if I have existing items of plant and equipment on my balance sheet, they may be able to be written off. Okay, so some of the stuff I've originally purchased may be able to be written off, and I purchased that stuff previously. And again, the old simple thing that it's not an aggregate. So in terms of that, I can buy 5 items for $100,000 and each are eligible. And it's not as though I purchased $500,000 worth and I'm ineligible. So the aggregation doesn't apply in terms of this, which is, again, it's sensible rules. It's encouraging people to go and spend the money.
Yeah, and we've seen that particularly, you know, some dental equipment going to new practices and stuff. You might have an invoice from one supplier for $350,000, but it's by the line item on that invoice.
And practically speaking, in a dental example and things like that, is that there's most items of plant and equipment, and I don't mean like buying a computer and then pulling all of the computer chips out of it and trying to buy them by chip. What I mean is in terms of there's lots of things like that. For example, a chair is separate to a compressor, it's separate to an autoclave.
Yeah.
In terms of these things, you know, as is a desk separate to a computer, and as is a computer separate to all sorts of, you know, to a lampshade, right? So in terms of this, you can usually strip these things down to be fully eligible, and you can do them in a very straightforward, honest way with a lot of integrity that you're not going to get in trouble for. Most of the audit activity generally from the tax office is simply, did you spend the money?
Yeah.
Did you install it?
Yeah.
Okay, right to go. When ATO audit activity happened through the GFC, all they wanted to see was invoices and proof of payment. And because their charge was not to really say, well, hang on, you know, was it depreciated properly? The charge was, did they really spend the money?
Yes.
Right? Because if you really spent the money, that's what we wanted. That was the goal of that program.
Yes.
And just like the goal of JobKeeper is to keep people employed.
Yeah.
And that's the focus of the program.
Yeah, fantastic. So I might just give a little bit of flavour, because we obviously, you know, up until 2 weeks before the end of June, we thought 30th of June was the deadline. Everything was getting a bit chaotic in June. I'm not going to lie. Some of the interesting learnings were that, you know, this was obviously a very popular stimulus measure in terms of being able to reduce your tax. The one constraint I found from, you know, obviously working with lots of our suppliers was the ability for them to get stock. You know, with the pandemic, it has absolutely changed how goods are shipped across the world, and the ability to get stock as well. And so therefore, unless the stock is here on shore, there's quite a long lead time for it to get here and be installed. So, you know, probably a number of customers we had running into 30th of June who were worried that their order wouldn't land on shore in time. And now, look, the government's extended to 31st of December, so that's no problem. As we go through September, October, for some of the suppliers or car dealerships you might be dealing with, there might be a 2 or 3 month wait to actually acquire that item. So that would just be my advice to anyone who is thinking about this leading up to the 31st of December is make sure you're having your conversations early. Don't leave it till the last minute, because the last thing you want to get to is going and seeing someone at the end of November or the end of start of December and agreeing to purchase something, but yet it not being able to be there and installed prior to the cutoff.
Yeah, look, Tim, I can just say, look, factually, what we're seeing at the moment, cars are a nightmare. So once upon a time, you could get anything you wanted, within 48 hours notice. We're finding a lot of our clients are having real issues getting cars. The price on cars is going up, right? But the price on used cars is going up. So a lot of vehicles are now being sold above recommended retail price because people are competing for the limited stock. My advice as an accountant would be I'd much rather you bought a bit of equipment for the practice than a car, and wait till the stock fixes itself next year, because no one should ever pay a car dealer above what a car's recommended retail is. That's just a way to blow up money. And I can speak from experience, because I'd ordered a car that was supposed to be delivered at the start of July, and they're now saying sort of December, January, so I cancelled the order.
Oh, right.
So I'm carless, so I'll be getting a bicycle, I think, or something like that. Yeah.
Mate, the weather's turning. It's a good time to be riding.
Good time to a bicycle. Yeah, I'd lose a few pounds.
All right, I am just conscious of time.
Tim, sorry, that last slide there. Just for everyone, the next one. So just for everyone's reference, this is a couple of really good government websites. So the business.gov.au grants and programs and aim.com.au. So one's the Australian Institute of Management, the other one's obviously Treasury and the Tax Office. Both have, the Treasury ATO one, which is the business.gov.au, has a really good question flow chart, and it will identify any grants or government programs available to you, including your industry and the jurisdiction/postcode that you're in. Give it a run. There's local councils all over Australia offering, everything from, like a free sausage sizzle through to $10,000 grants for businesses restarting. There's lots of stuff out there. Explore it. Your advisor just cannot be across the sheer volume of these that are being afforded to people, particularly in local council postcodes. So have a look at those. If you've got the laptop on the couch, on your lap on the couch one night, just have a bit of a troll through and see if there's anything relevant. And depending on where you practice, you might be eligible for one postcode, but on another, apply for that postcode. Yeah.
Okay, cool. Well, I'll leave that slide up as we go through question time, just to give everyone the opportunity to take down those details if you need it. We will run through some quick questions. I am conscious of time, but we do have some questions coming in. If you've got something you'd like to ask, if you click the chat button on the right-hand side of your screen, you'll be able to leave a question for Heath and I. So I might just kick off with one that I'll probably be able to answer, and this question comes from Costa, and he asks, is the banking relief package mandated for smaller financiers? So the short answer to that is the banking relief package is mandated for any member of the Australian Banking Association. So for any financier who's a member of that association, then it is mandated for them to provide that to you. If they are not a member, then it is not mandated. And the reason why is I think APRA are providing relief to the financiers of the banking association, so that those loans aren't being treated as if they're in default during that period. So if you deal with a financier who's not a member, that option might not be there. Look, there are other ways through using working capital facilities and stuff you can use to help trade through, but in terms of that package, it's only for those members. All right. Heath, I think you might have answered this, but this question's from Sharon. But Sharon's asked, if she orders a car that's going to take 6 months from now to be delivered, does that mean it can't be included as part of the instant asset write-off?
Very topical, and one that is dear to my heart at the moment. But yeah, the car has to be registered, delivered, compliance in your hand, registered prior to 31st of December this year. So in terms of that, the luxury limit is 59,000 and change. which means that if you bought a car for $150,000, you're only going to be able to depreciate the luxury limit, which is just under $60,000. In terms of that, just be careful about the decision on a vehicle. Given the supply-demand issues, I would be very hesitant to recommend buying a car in the next 6 months. I would be very positive and proactive about buying equipment for the practice. Look, again, if the car is a necessity and you're going to keep cars if you're someone who keeps cars for a long time, maybe do it. But in terms of that, it has to be delivered.
Okay, cool. Thank you. Question here from Richard Caswell, and I think this might actually answer a couple of questions we've got, because I think Wilson, you asked the same question as well. So, are components of a business fit out, partitions, flooring, glazing, cabinets, etc., able to use the instant asset write-off?
Yes, absolutely. So in terms of that, the instant asset write-off doesn't have to be a movable bit of kit, a keyboard, a computer, a vehicle, a machine, or something like that. If, for example, you spent $50,000 on some cupboards and a bit of cabinetry at work and things like that, totally claimable. Less than $150,000, they just need to be plugged in and installed, ready for use prior to the 31st of December. So in terms of that, now, if we're getting into and again, the sort of work you're probably able to get done and installed between now, the 2nd of September and 31st of December, is probably going to be, you're probably not going to be pouring huge slabs and digging car parks and that sort of stuff like that. It's probably going to be more cosmetic. But again, everything from a front reception desk to equipment to cabinetry to changes and fit out and things like that, so long as the spend is, and again, this is the other component. I'll be careful here. What I'll say is that if you get a quote to do a slab and put in new walls and a roof, and that quote's $400,000, and you try and break it up into wall number 1 and wall number 2 and wall number 3, that might be a bit cheeky.
Yeah,
right? I suspect on that. I'm not sure I would advise on that basis. But if I had cabinetry in room 1, 50,000, cabinetry in room 2, 50,000, chair in room, and again, I'm thinking about dental, but in terms of that, and it was breakable down in terms of to stuff that are physical, things like desks and cabinetry and those sorts of items, and I would be pretty comfortable with writing them off. Yeah.
I think almost the test is like the car park and probably a swimming pool. If it's capital improvement to the property, then it won't be eligible. But if it's, additions after you put the walls in, then it's probably okay.
If you're some sort of occupational therapist, and it involved a new pool for $30,000, you're probably okay.
Yep. Okay.
In terms of that, and air conditioner, absolutely. Air conditioners equipment, there's no issue with that at all. Stuff in relation to practice or shop fit out is usually okay. But again, you need to look at the big stuff. Sometimes is not. The big stuff is deemed not equipment stuff. It's deemed an actual real strong capital improvement and may be excluded. I would just get specific advice before you spend the money. And also, the builder has to have embedded in their contract some form of penalty equivalent to the tax saving you get if this stuff isn't done by Christmas.
Right.
Because if you're gonna commit to $100,000 worth of cupboards and fit out and that sort of stuff like that, and it doesn't happen until January, you're not going to get the tax deduction.
Yes. Yeah. Absolutely.
So the builder needs some incentive to make sure it does happen. But again, if you're going to enter into any contract with a builder or a fit out, get your lawyer to have a look at it.
Yeah. Builders working over Christmas, Heath?
Oh, it depends. Again, this is one of the things I would say about the economy at the moment. I don't know if anyone has done any minor works or is trying to engage a builder. Those guys are busy. And that's not a sign of an economy that's in trouble.
Yep, agree. Couple more quick ones just before we finish off. Sharon's asked, do we know any details for staff on maternity leave with JobKeeper and whether they'll get JobKeeper in September?
Look, that's a real HR question. I'm going to let that one through to the keeper because I need to ask lots of other questions around when they went on maternity leave and how long they've been there and things like that. All I would say is in terms of that, if you were still making the payment, they still had a job, and you paid them up to the JobKeeper threshold, then you should get the JobKeeper payment back if you're originally eligible for it. But I would defer to your professional body's IR team on that one.
Okay, cool. And then the last one I might go through is just from Kelly. Kelly's asked, she's concerned that even after a 4-month extension, that her practice might still be in trouble. Is there anything she can do now to try and fix that issue down the track?
I'm not sure I understand the question, Tim. So if I get JobKeeper for say till 31st of I can't remember the exact date, but the end of March.
Yep.
What happens?
Oh no, it's more about so you've been under 6 months payment deferrals, and you take another 4-month extension. If you're concerned now about your practice coming out the end of the 4 months, what could you do now to sort of try and get ready for that?
I will answer this in a non-financial way. What I would say is that if you have idle hands, then they should be used to do things that are not clinical. So by that, what I would mean is, in terms of it, there are a lot of practices, there's a lot of metropolitan medical centres that are closed because the CBD is empty. If they're lucky, they've been able to redeploy the staff and the doctors to other sites that they have in the group. I know that there are lots of cosmetic and also dental practices that have got a whole lot of people on the phone, and the dentists on the phone ringing up patients and things like that because they're quiet. Now, in terms of that, some people go, I'd never do that. I go, well, I can tell you, as one professional to another, get on the phone, right? And the other thing too is if you've got some downtime and you are worried about where things are going, then clearly you're not busy 9 to 5, like you're not flat out. So if you're not flat out, think of what else you can do. And in terms of that, it might be a great time to do a course, skill up. It might be a great time to do a bit of some form of management training. Could be a great time to do some of those sorts of things. The Australian Institute of Management is listed on there. They're offering, if you are eligible, certain types of management training. There's lots of different practice consulting groups and support groups. I'd be using downtime to skill up, talk to existing patients, look at marketing strategies I could do myself. I'm not saying get on your BMX bike and do a letterbox drop around your suburb, but what I would say in terms of that is that if as someone who's used to being very busy myself, I would be finding a lot of things to do if I didn't have anything to do here at work. I'd get bored very quickly.
Yeah, great. Thank you. Okay, look, I'll wrap it up for the questions there. Thank you to everyone who put through to request the cash flow template. We'll make sure that makes its way out to you. Just on this final slide, I've got Heath's contact details. Our customers work very closely, or a number of our customers work very closely. Oh, I'm getting tongue-tied with Heath and Ecovis. They're a fantastic supporter of the medical industry. And if you have any questions around cash flow in particular or instant asset write-off, and you want to know how it might work for your personal situation, please reach out. Heath, thank you for joining us. Fantastic to have you as always. Thanks to everyone on the line for taking the time out of your night. I know it's hard to take time out from families, particularly after, obviously probably what's a long day at work, but we really appreciate it. Our series continues on in a fortnight time. We're covering a wide range of topics over the next couple of months, which includes residential and commercial property investment, updates from Peter Monkton, our chief economist, as well as looking at either how to start a practice in today's current market, or acquire and sort of grow your practice as well. But thanks very much for your time.
Well, thanks, Tim.
Thanks.
Ryan.
Cheers.
Bye.